what is this myth? It's that indexed universal life is simply a permanent cash value life insurance policy wherein the cash values are invested in an index mutual fund, like variable life, but it's invested in an index mutual fund. Nothing could be further than from the truth, okay? See, I'm going to prove to you that Americans, if they had their money invested in an index mutual fund during the Great Recession, they would have lost up to 40% twice during that 12-year period, whereas our clients with indexed universal life, they didn't lose when the market went down. They ended up with doubling and tripling their money, while money in the market barely came back to break even. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for more than 5 decades, helping thousands of Americans optimize their assets and minimize taxes. And I do that by helping them keep in their serious cash earmarked for long-term goals such as retirement or college funding for their kids or working capital for business in a vehicle that will be liquid. They can access that money when they need it, safe from loss of principal, and earning a predictable rate of return that's outpaced inflation and have it be tax-free. And so that's the L.A.S.E.R test, liquid assets safely earning returns. And that's why I call a property structured max funded IUL a L.A.S.E.R fund, okay? So this myth here is that index universal life is simply a permanent life insurance policy wherein the cash values are invested in an index mutual fund. Baloney. Let me show you if that were true. This is the Great Recession. We're going to start on this chart in November of 1999, and we're going to go 12 years to November of 2012, okay? Some people call it a lost decade. It was actually a 12-year period. So let's say you were a couple and you had been saving money in IRAs or 401ks invested in the market, and you had $1 million nest egg at the turn of the century, and you were planning on retiring. Oh, my heavens. You probably had to put off retirement at least 7 years. You felt like you lost your future because if you retired, you would have depleted most of your $1 million nest egg in the first 3 or 4 years, because the market dropped down after the 9/11 terrorist attacks and did it for 3 years in a row. Okay, and so if you had your money in the S&P, this is the S&P. Okay, if you had your money in the S&P, like in an indexed fund, you would have lost 30 or 40%. Your $1 million would have gone down to, $600,000 or $700,000. And it would have taken 4 years from 2004 to 2007 to finally get back what you lost. And you'd finally be above water. And now you decide to retire. But as Warren Buffett put it, he said in 2008, when the tide went out, it revealed who was swimming naked, is what he said. People weren't protected. So people lost 30 to 40%. Again, their $1 million nest egg went down to $700,000. And it took 4 years to come back to where their million they started with 12 years earlier was finally back to $1,046,000, which didn't even keep up with inflation. That's money in an index mutual fund. See, that's not what IUL is. It's not your cash values invested in an index mutual fund, because you would have lost big time twice. Our clients did not lose a dime. When the market went down here, they kept their money up here. They may not have made anything in 2001, but they didn't lose. But in 2002 and 2003, when the market was still going down, our clients just switched back to the general account portfolio rate and earned 5%. And so they were clear up here. And then they started making money like crazy again. And then when the market crashed in 2008, they were already clear up here. Our clients were cheering in 2008. Go, go. They weren't losing a dime. They may not have made anything much in 2007, but 2008, they locked in gains in the first quarter of 2009 of 16% tax-free. So many of our clients ended up with $2.5 to $3 million at the end of this 12-year period by using indexed universal life, because if they had IUL and it was invested in an index mutual fund, they would barely be back to break even again, okay? That's the difference between an index mutual fund and indexing, which is a strategy. When you look at this is a pathetic 1/3 of 1% compounded rate of return by having your money in an index mutual fund in that Great Recession. See, if all you did was use an index universal life and you never changed the allocation, you might end up with 130% more money, $2.3 million, okay? But most of our clients had 2.5 to 3 million at the end of that same 12-year period. They 2.5, 3 times their money because they didn't lose when the market went down and they made money when the market went up. That's the beauty of indexing. From 2007 to 2012, very conservative example, money in the S&P, an index mutual fund, your 500,000 that you might start with would have gone down to 314,000, come back to 388 for you, and then maybe not even back to 500,000 by 2012. If you had money in an indexed universal life policy, maybe you didn't make anything in this year, 2008, or even in 2011. And maybe you capped out only at 10.5% in 2009, 10, and 12. You would still have at 691,000. You would have made 191,000 compared to still being down about $3,000 by having your money in an index mutual fund. Are you seeing the difference here? Sometimes I like to go back clear to 1975, the year after I started. I started in 1974 as a financial strategist. 500,000 invested in 1975 in the S&P. In the S&P 500 is this red line here. Yeah, you have some ups, you have some downs. People say, well, why do you want to miss out on these ups? Because I want to miss out on the downs, okay? And keep my money safe. Some people, they don't realize you go through this roller coaster ride, but see, a lot of people, when the market went down, they didn't hang in there. They sold low. And then they waited, and they bought back in high. So they didn't even average this. But if you stomached it, okay, and you bought and held, you would have had 5.6 million before tax by having your money in the S&P. From 1975, it would have grown 500,000 to 5.6 million by the year 2010. You say, well, that's pretty good. A lot of heartburn, but you could have had much more. See, you might get 5.6 million tax deferred in an IRA or 401k. Then you have to pay tax on that, and you're only netting 3.8. With indexed universal life, you would end up with 8 million. You didn't make anything during the down years, but you didn't lose. You'd end up with more money, and it's all tax-free. Let me ask you, what would you rather have? No heartburn and end up with 8 million tax-free, or go through a lot of heartburn to end up with a net of 3.8? This one's more than double. It's that simple. So that's why when I hear people say, oh, index universal life is just a permanent cash value life insurance policy wherein the cash values are invested in an index mutual fund. No, it isn't, or this would be your situation. This is IUL. That's money in an index mutual fund, okay? And so if you want to learn more, I would recommend you study my book. It's called The L.A.S.E.R Fund. L.A.S.E.R means liquid assets safely earning returns. This is how to diversify and create the foundation for a tax-free retirement by using max-funded IUL. Now, this retails on Amazon for between $20 up to $60. And if you buy it on Amazon, I want to thank you. But I'll gift you a copy for free. You can go to laserfund.com or click on the link below. And you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. And I'll cover the rest of that cost, and I'll pay for the book. So I'll fire out a hard copy of this to you via priority mail. And while you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, then there's formats available for your investment, and you're learning that way. But if you want to attend a free educational webinar, you can register for one of those. No cost, no obligation. You can even schedule an appointment to talk to an IUL professional that I oversee that will show you how a properly structured max-funded IUL may work in your particular set of circumstances.